Yo guys, what's up? So, as I promised on my Telegram group, I promised I'm going to talk to you guys about how I view liquidity, right? So, I'm going to make this into let's say, about a three-part video series where I speak about buy side liquidity, sell side liquidity, and my own special liquidity pool that I call symmetric channel trendline liquidity. Now, while I will not give any advanced sort of theory on YouTube, I will explain as much as I can to make you successful in being able to read liquidity the way I do. Okay, so let's start off with buy side liquidity, and this is going to be a relatively short series. So let's see what we can do with it, right? So when we speak about buy side liquidity, right, we are speaking about highs, right? We are speaking about highs. So it could be high resistance liquidity pools in terms of a high, or it could be a low resistance liquidity pool in terms of a high, or it could be just one simple high like that. So anything and everything above these highs, they are what? They are buy side liquidity pools. Okay. Now, here's the thing. When we look at high resistance liquidity pools here, low resistance liquidity pools, right? We expect or we can expect different sort of reactions, right? If we take out a high resistance liquidity pool, we would expect either a reversal or a deeper retracement into the broken range, right? If price takes out a low resistance liquidity pool, we would get not that much of a deeper retracement into the broken range. You could expect maybe about a 50% retracement back into the broken range, into an imbalance, and price will just resume to go where? To go lower, right? Or to go higher, right? So, okay, not lower, higher. Okay. So what can we do with this information? And that's the question. What can we do with this information? Now, whenever we look at the highs, right? If we have relative equal highs, okay, which is basically a low resistance liquidity pool, right? You as a trader do not want to be selling right below relative equal highs. Okay. You as a trader do not want to be selling right below relative equal highs, right? Because what you'll be doing is you will be placing your stops at or near a level or levels in which there's a large volume of stops, buy stops, making it buy side liquidity. Okay, so one rule is you should never be selling below relative equal high unless of course there is what SMT, right? Because we know that if there's an SMT at these highs, you are essentially in line with order flow, right? And order flow is going to be what? Bearish a bit until it reverses again to take out these highs. Because these highs, these relative equal highs over here, they are going to be taken at some point. Okay, they are going to be taken at some point, and there are certain algorithmic steps that price needs to take in order to take out relative equal highs and high resistance highs. Okay, there are certain algorithmic steps that price will take that will give us the ability to know exactly when and where these particular moves will happen. Okay, so let's talk about this. Let's talk about high resistance highs. All right, I just said if price takes out a high resistance high, okay, so if price goes up and takes it out, what can you expect? You can expect price to retrace deeper into the broken range. Okay, you can expect price to retrace deeper into the broken range. So let me draw this for you. We don't need this. There you go. All right, so we have the high resistance liquidity pool. So your rate created, and price takes it out. Okay. Now you always have to keep in mind, right? You have to see what did price break. So this is a high. All right. Now this is the high over here. All right. So we understand just by this explanation that this is a high resistance liquidity pool, a high resistance high, basically a high resistance buy side liquidity pool. Okay, so there's going to be a large amount of stops in terms of volume as well above these high resistance liquidity pools. Now, why is it called a high resistance liquidity pool? It's because price made a higher high, and then it broke down, right? So if it broke down, that means there was a reason in which they broke down. It's because there was an entity with a large enough order that caused price to go lower. So which led to the algorithm repricing lower. Okay. When that happens, and when price takes out this liquidity pool, this buy side liquidity pool, we are looking for a move back deeper into the range. So not here, not the 50%, but we are looking for price to come back into this region of the range. And I'll show you an example or two. Okay, that is what we're looking for. We're looking for price to come back deeper into the range. And this is how you can actually identify or how you can determine just how far price is going to retrace, whether it's going to retrace into the 50% of the range or whether it's going to retrace into the 75, 80% of the range, right? So this theory is part of what I call my ranges theory. Okay, so this ranges theory of mine, which I built upon ICT, of course, takes into consideration the algorithmic steps required to come back into the range, going back out of the range, and how you can take entries based off this framework. Okay, so that's one example of how you could react after price takes out a high resistance buy side liquidity pool. But what about a low resistance? So let's say we have this here, we make a low and then price breaks up, right? What can we see? We can see that we have a high here. We have another high over here. But look, this was a low resistance liquidity pool, right? Because both the highs, they never really took out structure to the left. Therefore, they are low resistance. They are low resistant in nature. So if they are low resistant in nature, what we're looking for next is for price to come back just around the 50% of the range. And that's when you get your move up. Okay, that's when you get your move up. So you would want to look for maybe imbalance, your breaker entries, your fair value gap entries. If there's a large order block over here, you can use a large order block and stuff like that. Okay, so this is the main framework that you could be looking for on a fractal basis. You could have this happen on, let's say, the 1 hour, and you could frame 1 minute sells from here to buys from here. This could be the 4 hour, and you could frame 5 minute sells from here to 1 minute buys from here. Okay, this is the entire market cycle. Okay, these are the two distinctions between the market cycle when it comes to buy side price action. Okay, when it comes to buy side price action, and it's based completely on what type of liquidity did price take as it was breaking highs, whether it was high resistance liquidity or low resistance liquidity. Okay, that's pretty much it. And again, you don't sell over here. You can sell over here, but you're going to be met with what? You're going to be met with a loss. And that is a mistake you can make. That's no issue with that, because once you really understand that there was a loss over there, you can immediately change your game plan and get ready to sell from up there and buy back from down here. All right. So that is it about buy side liquidity. The next video will cover sell side liquidity. For now, let's look at some examples. Okay. So let's look at gold. All right. So gold, what can we see? We can see that we have a high, we have a low. Okay. Now see, this high is a high resistance liquidity pool because what happened? We took out another high to the left. Whereas this low over here, it did not take any liquidity to the left, right? So it's a low resistance liquidity pool. Now, if we anchor, or if we look at just how this range is using a Fibonacci from this low to this high, right? Where does price reach? The 50% mark. Why? Because here price takes out a low resistance liquidity pool. So your entry or your focus is the 50% range, right? And why is price going to come down? Because what can we see? We have relative equal lows. You never want to be buying and holding, think the price is going to go higher than that, right? It's not. It's going to come here, fulfill the range, and then take out obvious liquidity. Okay, that's one example. And then obviously you can see that we came back here and we broke up. Right, but this is a sell. So let me show you a buy. All right, so let's go back And let me take you guys through a trade that I took the other day. So that day would be over here. All right, look at this. We have a high, we have a lower high here. So what do we have? We have low resistance liquidity over here, right? So this is what we will be speaking about in the next series. But let's focus on the buy side example. So price goes up, 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 up. We take our high here, a high over here, a high over here, and a high over here. Right now, look at this. This high and this high. What do we have? We have a high resistance liquidity pool, just like that. Okay. This took this high up. So we are now grading the range. Okay, we are now grading the range broken from here to the range is low, which is here. And what are we looking for? We're looking for price to react from around the 75% area. So whatever point of interest aligns with the 75% point of interest, right? Or 75% valuation. And here you go. Here's your 75%, which is the middle of these two, which is in the middle of the larger range. Here's your 75%, and here is the buy. All right, so this is your buy. And I did in fact take it. You can go back to the Telegram group and you can refer to it. And based on my projections theory, you could go all the way up. So it would be here. That's your final target, and that would have been the trade. Okay, that would have been the trade. So yes, that's an example of how I use it on a daily basis from a practical standpoint. And obviously, the higher the time frame, the better. And you can frame your intraday ping pong, whatever you want to call it. You could do that on the 15-minute time frame and above. Okay. I really can't go into any more detail with this because then it would be unfair to the mentorship members. If you are interested, you know where to find me. The website will be linked down in the description below. And yeah, I'm planning on closing down my mentorship anyway because I'm gonna start doing my hedge fund thing a bit more seriously from now on, which is also a career opportunity for every student that is in the mentorship. Okay. Yeah, so that's pretty much it, guys. I hope you guys found this interesting. I hope you learned something from this. And let's see, because now if I'm looking at the current framework for gold, right? So we have a low, 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 we broke higher. All right. And what happened? We took here's a high. We take out another high over here, right? So what's this high? This high, it's a low resistance high because it does not take any structure to the left. So because it does not take any structure to the left, right? If we grade the range, what are we looking at? The 50% mark here. Okay. And this is a weak imbalance right over here. I would prefer if it comes just a bit lower, but this is my next point of interest. Oops. This is my next point of interest. Obviously, price drop down and they go higher because I have a target up somewhere over here. Right. That's pretty much it. That's what I'm looking for. And I know this trade will not make any sense if you're watching this way down in the future. So yeah, I hope you guys found this interesting. I'll go through sell side liquidity in the next video. Okay, so with that, thank you and have a good day.